from a corporate point of view, are you in a position where you effectively have to defend your top line or your bottom line? If you basically pass on prices, are ultimately consumers going to start pushing back, and as a result of which the top line gets hit, but your bottom line is preserved? It's a really difficult one, I think, for a lot of CEOs to manage right now. I thought the Heineken CEO was interesting earlier on when he talked about the idea that maybe we could see people pulling back on beer purchases, which is really serious stuff, as you and I both know, if that's what we're ultimately coming here. And the consumer's going to have to prioritize. So the question of the day, that was a long way to get to it. Have we reached the limits of pricing power? Well, let's ask Kathryn Rooney, Vera Bulltick Capital Markets Chief Investment Strategist, and our very own Mike McKee, Bloomberg's International Economics and Policy Correspondent. Mike, let me come to you first of all. I want to figure out what is happening with the consumer right now, because I think that's the starting point in terms of trying to answer this question. I thought the UMich data pointed to a consumer that was feeling concerned. I look at the retail sales data and I see a consumer that is still spending. But is the retail sales data real?
The retail sales data is real, but there may be some reasons why it wasn't quite as good as it appeared, Guy, because seasonal adjustment factors would have anticipated a drop-off and maybe boosted the numbers a little bit more than they otherwise would, because the numbers had fallen so much in December, as you say, because of the pull-forward effect. Also, inflation is playing a big role here. The retail sales numbers are calculated in dollars, so higher prices mean more sales, at least as far as the retail numbers are concerned. The one thing that I would mention, however, is that the consumer surveys don't really tell us a whole lot. Alan Greenspan famously said, we watch what they do, not what they say, because while the overall numbers, the overall sentiment has been that the U.S. economy is kind of lousy, other surveys show that people think their own situation is pretty good, so they can keep spending as long as they have that money in the bank. The question is what happens when that gets spent down.
All right, so that's on the consumer side of the equation, Kathryn. To bring you in here for the corporate side, does the data we're seeing make you confident in their ability to continue to shore up their margins, to exercise that pricing power?
Right, and Mike's right, especially for demand inelastic goods like consumer staples, you really shouldn't expect to see too much of a drop-off in terms of purchasing those items, especially when we consider, the lack of substitutes, or as our team has discussed internally, a change in consumer behavior. So in the absence of either of those two things, we should expect, for example, beer costs to continue beer demand to continue remarkably robust as it historically has been. But even more importantly is, of course, wages. So, as wages go up, more dollars in your pocket offsets the weaker dollar story. So I'm pretty confident in the ability both of the consumer to continue for the foreseeable future. I mean, this can certainly change, and corporations, both from consumer staples to discretionary, to continue to be able to pass along those costs as wages continue to offset that weaker dollar.
So basically, people are going to get wage rises. They're going to spend those wage rises, Kathryn. My question to you is, and you're kind of alluding to this, what are they going to prioritize? It sounds like you think they're going to continue to prioritize beer, which is, I would have thought, fairly important. But nevertheless, what else do they prioritize?
Well, consumer staples are by definition, of course, basic goods that people are going to continue to consume. Beer being one of the most important and well known of those, kind of inelastic goods. So discretionary, I think, is where we need to historically look. But a red hot labor market, I think, is going to continue to give a boost to the consumer demand. What I'm really looking at, though, Guy, is confidence. Confidence has been on the decline, and that's, of course, because of inflation expectations, which the Fed is particularly keen on. As those continue to rise and start to dig into purchasing power, then you should expect corporates to be unable to further pass along those costs. We are still seeing opportunities, however, in staples, especially those higher priced items. You can continue to pass along those costs. And I'm still pretty positive, especially in this first first half of the year, with economic growth being as robust as it is. The wealth effect, we haven't even discussed that. Equity markets still remain exceedingly high. We have asset prices across the board. You know, you can finance yourself. Your house is worth a ton of money. Wages are increasing. Retail sales just came out this morning, spectacularly strong. So things are still looking good from the perspective of corporates to be able to pass along and consumers to continue to foot the bill, although completely complaining about it all the time, which everyone can understand.
Yeah, but they'll still be buying beer. And I would love to talk more about that.
Right.
Guy and I's fundamental disagreement on whether Stella Artois is or is not a good beer. But Kathryn did mention the Fed there, Mike. So I have to go to you on that because, of course, we are going to get the minutes later on this afternoon. Strong retail sales data, consumer looking good, inflation running hot. Is there any reason not to move 50 basis points next month?
Well, there's reason to move 50 basis points if you think that the Fed is behind the curve. The numbers are sort of justifying your viewpoint at this point. However, we've only heard really from Jim Bullard. So we'll need to hear from others to see if they agree that that's likely to happen. But we could get another tantrum today in the markets as we did the last time the minutes were released, because if there's a lot of concern expressed, or if they talk about 50 basis points in the minutes, then people will read into that, I think, for what they might do in March.
And it'll be interesting to see whether the market ultimately extrapolates. You get 50, do you extrapolate to another 50? Kathryn, what's your take on this?
I think if Russia does invade Ukraine, 50 bips is completely off the table. Anything can derail this Fed. This is a Fed that I think has been behind the curve, should have started tapering, months and months ago, and should probably go 50 bips. But as I say, the Russia issue could take that off the table.
Well, and speaking of some of the other risks that are out there other than central banks and geopolitics, Kathryn, where do you feel comfortable putting your money?
I think we have to remain overweight equities, especially in rate-sensitive and inflation-sensitive sectors. That's been my view in Bulltick for the past year. We've been talking about inflation being the primary risk for more than a year, and I think that's where we need to continue to look for value, especially in alternatives. Assets that have low correlation to the public markets. You want to be invested in alternatives, even cryptos, even commodities. You want to be in sectors such as industrials, materials, staples, banks. And I even added to our overweight list healthcare because I think valuations are attractive there. I think you want to stay away from the emerging markets at this juncture. It all depends on what the Fed does. If the big banks are right, it's kind of a race to be the most aggressive in terms of who can say how many times the Fed is going to hike. I personally think the Fed is going to surprise on the downside than to the upside of what the currently Fed funds future rates are pricing in. Anything can derail this Fed's intention to tighten. I think it's a Fed that's unlikely to go too aggressively because that could completely put a brake or reverse this economic expansion.
Kathryn, there's a lot of kind of ifs and buts in there, though, and we're trying to figure out what the uncertainty is ultimately going to bring us and how it is going to crystallize. Where do you sit on cash right now? I'm wondering how you get some optionality around some of this uncertainty.
There's a lot more downside than upside from current levels. Inflation is going to peak in March by our forecast, so we're going to see above 7.5% inflation. But thereon, from April through the end of the year, we're going to see inflation mean revert, and that's because of statistical base effects. Last year, inflation was very, very high from April through the year end, so you're going to see inflation come down. That's going to give the Fed a breather in terms of having to increase rates, at least from an inflation-fighting credibility perspective. So I do think that there's still equity upside. I think that there's a lot of volatility inherent in the Fed's intention to remain data dependent, which in my view, they no longer should be. There should be a plan of attack to reverse the inordinate monetary expansion and stimuli that we've seen thus far. But that data dependency inherently brings volatility. So yes, be ready to weather that volatility. I would be buying on big drops in equity markets. As I say, I think it does come down to the Fed. It's a big if, but that's the primary risk. I think the Fed, as I said, is already behind the curve, but they're loath to increase rates too aggressively and precipitate that change in the economic cycle, which historically has been at the hand of a too aggressive Fed.